Welcome to our financial accounting series. Today we're diving into the core financial statements: the income statement, statement of owner's equity, balance sheet, and statement of cash flows. We will explore each statement's purpose, components, and see how they interrelate to provide a comprehensive picture of a business's financial health. Financial statements are crucial tools that provide stakeholders with the information necessary to make informed decisions about a business. There are four primary financial statements. 1. Income statement. 2. Statement of owner's equity. 3. Balance sheet. 4. Statement of cash flows. Each of these statements serves a unique purpose, but together they paint a complete picture of a company's financial position. Let's start with the income statement. The income statement, also known as the profit and loss statement, measures the financial performance of an organization over a specific period. It lists the revenues, expenses, gains, and losses, culminating in the net income or net loss for that period. Imagine it as a report card for the business's operational performance. Revenues and gains increase the overall performance, while expenses and losses detract from it. The ultimate goal is to have a positive net income, which indicates profitability. The income statement typically follows this structure. 1. Revenue. All income generated from the sale of goods or services. 2. Cost of goods sold, COGS. Direct costs attributable to the production of goods sold by the company. 3. Gross profit, calculated as revenue minus COGS. 4. Operating expenses, costs required to run the business, such as rent, utilities, and salaries. 5. Operating income, gross profit minus operating expenses. 6. Non-operating items, includes gains or losses not related to the core business operations, such as interest and taxes. 7. Net income, the final profit or loss after all revenues and expenses have been accounted for. For example, consider Cheesy Chuck's Classic Corn, a fictional company. The income statement for June, the first month of its operations, shows all the revenue generated from sales and all the expenses incurred, including costs of goods sold, rent, and utilities. The difference between total revenue and total expenses gives us the net income for the month. Next is the statement of owner's equity. This statement shows changes in the equity portion of the balance sheet over a reporting period. It begins with the owner's equity at the start of the period, adds net income, or subtracts net loss from the income statement, includes any additional investments by the owner, and subtracts any withdrawals by the owner. Think of the statement as a bridge between the income statement and the balance sheet. It links the net income from the income statement to the equity section of the balance sheet, demonstrating how profits are either retained in the business or distributed to the owners. The statement typically includes 1. Beginning owner's equity, the equity at the start of the period. 2. Additions, including net income and any additional investments by the owner. 3. Deductions, including net losses and any withdrawals by the owner. 4. Ending owner's equity, the resulting equity at the end of the period. For Cheesy Chuck's Classic Corn, the statement of owner's equity for June starts with the initial investment by the owner. It adds the net income from the income statement and subtracts any withdrawals made by the owner, providing the ending balance of owner's equity. The third statement is the balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets, liabilities, and owner's equity. The fundamental accounting equation that underpins the balance sheet is assets equal liabilities plus owner's equity. This equation must always balance, hence the name balance sheet. Assets are resources owned by the company, such as cash, inventory, and equipment. Liabilities are obligations the company owes to others, like loans and accounts payable. Owner's equity represents the owner's claims on the business, which includes initial investments and retained earnings. The balance sheet is typically structured as follows. 1. Assets, current assets, cash, accounts receivable, inventory, etc. Non-current assets, long-term investments, property, plant and equipment, PP&E, intangible assets, etc. 2. Liabilities, current liabilities, accounts payable, short-term debt, etc. Non-current liabilities, long-term debt, other long-term obligations, etc. 3. Owner's equity includes the owner's capital and retained earnings. Using our example, Cheesy Chuck's balance sheet at the end of June shows the assets the business owns, the liabilities it owes, and the owner's equity after considering the net income and withdrawals. It's like a financial snapshot that tells us what the business owns and owes at a specific date. The final statement is the statement of cash flows. This statement reports the cash inflows and outflows over a period. It is divided into 3 sections. 1. Operating activities, cash flows from the core business operations. 2. Investing activities, cash flows from buying and selling assets like equipment. 3. Financing activities, cash flows from transactions with the owners or creditors, such as loans and investments. The statement of cash flows is essential because it provides insights into a company's liquidity and solvency, showing how cash is generated and used in operations, investments, and financing. The statement of cash flows typically includes 1. Cash flows from operating activities, adjustments to net income for changes in working capital and non-cash expenses like depreciation. 2. Cash flows from investing activities, purchase and sale of long-term assets and investments. 3. Cash flows from financing activities, issuance and repayment of debt, issuance and repurchase of stock, payment of dividends, etc. 4. Net increase/decrease in cash, summing the cash flows from operating, investing, and financing activities. 5. Cash at beginning of period, the starting cash balance. 6. Cash at end of period, the ending cash balance after all cash flows are accounted for. For Cheesy Chuck's Classic Corn, the statement of cash flows for June includes cash received from sales, cash paid for expenses, cash spent on purchasing equipment, and cash received from loans. It provides a detailed picture of how cash moved in and out of the business during the month. Now, let's discuss how these statements interrelate. The financial statements are not isolated reports. They are interconnected. 1. Net income link. The net income calculated in the income statement is carried over to the statement of owner's equity. This figure adjusts the owner's equity by either increasing it if there's a net income or decreasing it if there's a net loss. 2. Owner's equity link. The ending balance of owner's equity from the statement of owner's equity is then reported in the equity section of the balance sheet. This shows how the net income and owner's withdrawals affect the overall financial position. 3. Cash flow link. The cash at the beginning and end of the period reported in the statement of cash flows should match the cash balance reported on the balance sheet. This ties the cash activities during the period to the overall financial position of the company. For Cheesy Chuck's Classic Corn, the interconnectedness is clear. The net income from the income statement for June is added to the beginning owner's equity in the statement of owner's equity. After accounting for any withdrawals, the ending owner's equity is then reported in the balance sheet. Meanwhile, the cash flows from operations, investing, and financing activities reported in the statement of cash flows explain the changes in the cash balance on the balance sheet from the start to the end of June. Let's delve deeper into our example with Cheesy Chuck's Classic Corn to see these interrelationships in action. For June, Cheesy Chuck's recorded $10,000 in revenue from corn sales. The cost of goods sold amounted to $4,000, giving a gross profit of $6,000. Operating expenses, including rent, utilities, and wages, totaled $3,000. This results in an operating income of $3,000. After accounting for interest expenses of $200 and taxes of $400, the net income for June is $2,400. Starting with an initial equity of $5,000, we add the net income of $2,400. If Chuck withdrew $500 for personal use, the ending owner's equity would be $6,900. At the end of June, Cheesy Chuck's assets include $3,000 in cash, $4,000 in inventory, and $8,000 in equipment, totaling $15,000 in assets. Liabilities consist of a $4,000 loan and $2,100 in accounts payable, totaling $6,100 in liabilities. The ending owner's equity, as calculated from the statement of owner's equity, is $6,900. Thus, the balance sheet balances with total assets of $15,000, equaling total liabilities, and owner's equity of $15,000. For June, Cheesy Chuck's generated $3,000 in cash from operating activities, net income adjusted for changes in working capital. Cash used in investing activities includes $2,000 spent on new equipment. Cash from financing activities includes $3,000 from the owner's initial investment and $4,000 from a loan. After accounting for the $500 withdrawal, the net increase in cash for June is $3,500. Adding the beginning cash balance of $500, the ending cash balance is $4,000, which matches the cash balance reported on the balance sheet. In summary, the income statement, statement of owner's equity, balance sheet, and statement of cash flows are the four primary financial statements used to assess a company's financial health. Each statement provides unique insights, but together they offer a comprehensive view of the financial performance and position of a business. Understanding how these statements interrelate is crucial for making informed financial decisions. By closely examining each statement and their connections, you can gain a deeper understanding of how businesses operate and manage their financial resources. This knowledge is invaluable for investors, managers, and anyone involved in the financial aspects of a business.